Hi friends, welcome back for Bitcoin Technical Analysis with me, your pal, Rocky Outcrop, and in today's episode we're going to check out a harmonic pattern called the Gartley pattern. And the guy that came up with it was called Gartley, and he wasn't like Kanye West or something. He didn't name it after himself. It was people subsequently named it the Gartley pattern. So if you put off patterns because people have got big heads about them, then don't let this one put you off quite yet. And it's quite a successful, good pattern to look at. I think it's a good opportunity for us to have a sort of positive look at the market after all that bearishness, and it's a good way to spend our Sunday. So let's roll those intros and get on with the chart. So yes, once again, thank you so much for joining me in today's episode. And you can see that the chart up behind me is the Bitcoin US dollar 3-day chart. And I think that some Bitsnap. I think that the sort of this pattern, this XABCD Gartley pattern, works best on this chart. Now, if you've never seen one of these before, don't be a feardy. I will explain it all in just a second or two. And it is a complex thing, okay? And there's a lot of further reading for you to do about this if you want to do yourself. But I'm going to sort of distill it down and what I think is the easiest way to understand it, or at least give you my sort of how I would explain it to somebody in 5 minutes or less. And let's just hope that it works out as understandable. Who knows? So, well, what is it, right? What is a Gartley? What is a harmonic pattern? Why do people do this thing? Well, people can kind of understand that the markets tend to move in specific ways, and if you've been trading for a while, you might have described the market at some point to somebody who's uninitiated how things kind of go up a bit, then they go down a bit, then they go up a bit, and they go down a bit, and woo, that's trading. And we all understand that that's how it works now, but that's obviously an oversimplification. And then the other end of the spectrum, you've got people who, like Elliot, for instance, who try to describe things in mind that same it goes up a bit, down a bit concept in much more detail. And then, but then that's kind of vague as well. And the end result with Elliott Wave is a little bit vaguer. And then there was other people out there around about the same time who came up with other ideas, and one of them was a guy called Gartley, and he said that should the market have a particular sort of set of circumstances about it, it presents an alright opportunity for a relatively low risk trade. And in this scenario, the low risk trade would be to be buying in around your D point here, looking for a retrace with profit taking targets. Naturally, you'd think around about the B target, C target, the A target, of course, and then the ultimate profit taking target up here at the 1.618 Fibonacci retracement area. Now, this is not a sort of an automated reaction to a particular set of Fibonacci numbers that have been hit, and therefore we all have been predestined to see the prices go this way. This is more of a description of the psychology around the trading over a significant period of time and how that can lead to certain things happening, and the low risk, high reward aspect comes from it, from being able to identify a crucial pivot in the market, as Jesse Livermore used to talk about in that we like to look for pivots and where you could find these reversals. Okay, so this is a reversal pattern, and it looks at it identifies a handful of pivots, and the way it does it is through these Fibonacci retracements. And of course, this is something that's as old as the hills. The book was published in 1935, and it was based on 40 years of research at the time. So we're going back to the 19th century there, and it still happens today, and this is the same, and the sun still rises the same way. We still have a moon and plants, this still the same sort of thing. While the world may be a vastly different place, some things kind of never change, and this may be one of them. And what is it? So then what can we say it is? And you might have noticed I've got a couple of tabs up the top there which go in to try and explain it. And well, this is what people normally talk about when they talk about Gartley stuff, or harmonics, is they kind of lull you in with a false sense of here's an easy line thing. You start reading about it and it seems easy enough when you read things like, it could be any price activity in the chart, no specific requirement. Now, that's very easy. And then you get a little bit of rules about how things should work. It should be approximately 61.8 in size, blah blah blah. Like you're looking for these specific targets, approximate specific targets. Then you start getting a little bit more complex, and you get these variables, like so it should either finish either on the 38.2 or the 88.6, and then you get these variables based on variables, and things get a little bit more complicated, and you're already starting to go off the whole idea. Whereas, like, if it's 38.2, then it should be 127. If it's 88.6, it should be like, you know, things get very, very, very complicated, and you're still not even done yet. And at this point, you're just like, you know, screw these things, you know, and that's very off-putting to people. And that wasn't the way it was described originally. So for the benefit of everybody who wants the sort of the too long didn't read version of this whole thing from very start to finish, here is the book that he published back in 1935, H.M. Gartley. And as you can see, this guy here says that the Gartley pattern is sometimes, it was on specifically page 222 of the book. Now, he obviously goes into, or he or she, whoever wrote this, goes into sort of extreme detail with the prices and the rules and blah, blah, blah. And Gartley himself actually was a little bit more sort of easygoing with his language, and I think maybe we can benefit from reading this. So they said it was one of the best trading opportunities, or could potentially be one of the best trading opportunities, over here on page 221 of his book, published, God, you know, almost a century ago. And so let's just have a quick read of this. It'll only take 30 seconds to read the sort of down to about here, and it gives us everything we need to know, really. So look, you know, in the life of those who dabble in Wall Street, at some time or another there comes a yearning just to buy them right once, if never again. Gosh, and especially after times like this, whenever you maybe would have bought it at specific times, and that kind of describes the psychology of people in and around these areas, you know, as well as it happens. For those who have patience, the study of top and bottom patterns will provide such an opportunity every now and then. So, you know, top and bottom patterns are the kind of the good opportunities that happen from time to time, and they can really be anything as well. And he describes several different ones in this book, like for instance the head and shoulders and stuff like that. And he also is a big, you know, he talks about Dow theory quite a bit in this book as well. So it's not really just, you know, like this is the holy grail that he identified and named after himself, like some sort of Kanye West guy. No, this is just his describing the psychology around the markets, and that's kind of, I think, key to all pattern trading, really. For those who have patience, study top and bottom, blah, blah, blah. But it does not arise every day, this chance. Now, when it does, a worthwhile opportunity with small risk becomes available. Let's look at let's not bother. When after an intermediate decline in either a bull or a bear market, such as A, B in the diagram, figure 27, by the way, is this one, which looks quite different to this one here. And he's talking about A, B, and C, as you can see there, and then on the sort of the other way around is A, B, and C, okay? And he's looking at, on the right hand side here, that's selling a short and this is buying a long. So you're talking after the decline, you get a long. So the decline would be all of this and then a long, okay? So when after an immediate decline in either a bull or bear market, such as A, B in the diagram, has proceeded for some time and the activity has shown a definite tendency to dry up, indication that liquidation is terminating. Now, this is one of these old school things for liquidation, which we're familiar with the term liquidation from, you know, get wrecked on BitMEX, but liquidation is just converting an asset into a liquid one, which is cash. So essentially, liquidation just means selling something. By the way, from this is historically and is also currently the correct definition. A minor rally like a BC sets in with volume expanding on the upside, and when a minor decline after cancelling a third to half the preceding minor advance BC comes to a halt with volume drying up again, a real opportunity is presented to buy stocks with a stop under the previous low. So all he's really saying there is that there's a good opportunity to buy stocks with the stop under the previous low, and over here you can see that actually the Gartley pattern kind of then evolves into this thing where your stop is the previous low for us would be here over at the D point, but of course he's talking about the previous low being over there at the B point as well. So you can see how the evolution of this thing and everything kind of loses touch a wee bit from what it was originally written about. But anyway, whatever. Moving on, in 8 out of 10 cases when each of these specific conditions occurs, a rally which will provide a worthwhile profit ensues. You know, and the other two small losses would be taken. In trading this formation, the observer is depending upon the probability that either head and shoulders or double bottom, which are the two reversal patterns which occur most frequently, is developing. So, you know, again, like you're looking to see these things develop potentially into another actual bottom pattern rather than this thing itself. So that's enough of an explanation there, and we can rely on things like this here to give us a sort of an indicator of where our numbers ought to be, but just kind of, you know, like this is not exactly correct. We do have the word approximately as well in there, and things, harmonic traders like to talk about things being exact, or else just ditch it, but you know, I think this is pretty close. when you look at things like the rise, like so on the XA, for instance, here, which is the low to the top from December to June in 2018 to 2019, had a decline thereafter that went all the way down as far as the 618, which is, I've got it's green here in this Fibonacci retracement. So it went down as far as that, a little bit further, but that's all good. Didn't actually continue really much further down past that. Kind of got down at that golden pocket. Then afterwards it went back up again. And where did that go as far as? Went as far as the 618, as you can see here, denoted by this line, this 06.17, and then it came all the way down here to the 1618 extension. Fibonacci extension from this high to low move down here, as we saw in the trading recently when we looked at Bitfinex and stuff like that. We saw that it went down as far as the 1618. And that's where we ended up. So we have the sort of the conditions which actually tie in with our with the chart here from the Gartley, and then you can say, well, what would be the move after the Gartley? And this guy likes to say that 1618 up here, so you can see that in a couple of different ways. I drew one on sort of just using some other tool. There's like another tool there you can use. This is called the cipher pattern tool, but all I really used it for was to see kind of roughly what this triangle would look like. But I don't think we really need that on the chart to see the point that I'm talking about, because it's explained with the Fibonacci retracement here anyway, because it's up at this 1618. So that could be the potential target overall, and that would be off the back of this potential pattern which was described by Gartley back in 1935, and then has been worked on ever since by other people to come up with sort of the specific rules for it and give you a prescribed formula to look for, and that could potentially go up as high as that 1618. And of course, where then would you place stops? Well, of course, you'd have to place your stops down there underneath 3,860. So like, is it wise? I'm not a financial advisor on this financial advice, of course, but would you be wise in getting into a long position from around 5,500 and only stopping out at 3,800 after you've lost 30 odd % of your investment? I think that's probably not the wise place for your stops, really, and I wouldn't base my own chat on the target there. But you have this 236, and I often talk about the 236 actually validating Fibonacci retracements. If we get an open and close above the 236 here at 5,500, which lasts for a decent period of time, as you can see, if we go down to the 4-hour time, that we've only ever had a couple of candles up above it. We're looking for like decent sized candle closes up above, and really by that what I mean is the 24-hour. Then you'd be able to look towards these upside targets, and you would be able to consider looking back that we had a Gartley here and be able to explain to people just how the psychology really panned out from things, because as you look towards the upside, if you were to make it back up through these certain different previous highs and previous lows, then you can go back to looking at how Gartley himself would have described this here, and it's like that he wants to stress the idea of the decisive penetration. This is essential in using penetrations of previous turning points in making new or additional commitments, without which the trader runs a much greater risk of buying at a top or selling short at a bottom. So what he's really saying there is that if we make it through these areas, along with volume coming in and more enthusiasm coming into the market, then that will build up its own momentum all the way up towards where you're going past, once you go past the C point, then you'd be looking up towards the A, and then you might actually have built up enough momentum as a result of this previous price action going back over a couple of years now, or a year and 18 months or so, that actually takes you up to that point there as a potential full move off the back of it. So that's the overall idea. That's the long term. Somebody asked me in a video yesterday to say what I would thought long term, and I think there's your long term answer for you, and all of the intermediates in between, obviously, for profit taking targets and all the rest of it too. And like I say, opens and closes above there, or else we're looking down the way, potentially to where that stop would have been. And if we're looking towards the upside, then you've got targets of 6.5 grand. Of course, here it's 6,850, 7,265, 8,000. The next one being 9,150. The next one being 10,729, the next one being 13,000, and the next one thereafter being 14,784. And that's kind of the short, middle, and the long term of this asset for now. Thank you so much for tuning in. I hope it did it justice, or okay job with that, and no doubt I've left people kind of confused as to what these things are, why they use them, and whatever else. Well, I hope that over time I kind of do a better job explaining things, and you can let me know in the comments down below. Thanks so much for tuning in. See you next time.